In Fort McMurray, there's one thing that reigns supreme: oil prices. And when those oil prices begin to get a little bit shaky, that's one of the scariest issues a business can face. If a business is lucky, it's an issue they'll never have to deal with. But if they're smart, it's something they plan for, and it's something they could leverage in the future. This is the situation that you, Mr. Sparks, are facing with Garamond Construction Rentals today. Currently, the oil prices are a little bit shaky in the market, but we, as Vet Consulting, believe that this is something that you can take full advantage of. My name is Chantel, this is Vivian and Eddie, and we're very excited to speak to you about the exciting opportunities you have in the oil industry today. So, what's the big issue here today? Well, the question that we've identified is, what strategic opportunity should Garamond pursue, and what's its impact on your future operations? There's 3 different potential opportunities within the market, all quite different, and all of which could take you in a completely different strategic direction. So that's what we're going to dive a little bit deeper into today. So, what's your current state? Well, in Fort McMurray right now, your organization, Garamond, has its management based in Eastern Canada. So you don't really have any of the senior management team within Alberta at this time. So you're sort of managing from afar in that sense. There's also a focus on construction equipment equipment sales and rentals. Rather than tools or the housing market, you guys are mainly just focused on the equipment aspect. Looking at the customer, there is that preference for rentals rather than buying that equipment, as the industry is rather unpredictable with the oil prices that I mentioned earlier. Also with the customer, for you as well as the people that are buying or leasing your equipment, it is a very highly competitive market. So that's something to keep in mind, regardless of what scenario you move forward with, as there will be pressure from all sides wanting to take that market share that you currently occupy.
So when looking at the current industry analysis, as Chantal mentioned previously, when making the decision moving forward, should you move into Fort McMurray, we had to consider the oil price uncertainty. Is the oil price going to increase at a level where the company is going to prosper? Are they going to be able to have the oil prices increase where a lot of companies within Fort McMurray are going to want to pursue and rent equipment moving forward? Secondly, with the oil prices being uncertain and the way the economy is operating, we want to make sure that when we're doing these acquisition, or if we're wanting to take over and invest into Fort McMurray, we want to make sure that you are paying a fair price. We want to make sure that every dollar that you invest into the operations in Fort McMurray is worth every dollar of your investment. And last but not least, with Komatsu being one of the main partnerships of your company, we want to make sure that whatever opportunity that we're implementing or recommending, that that the relationships moving forward will be a beneficial one for both parties. So when approached with the different opportunities, first is we want to look at, should we exit Fort McMurray or should we remain in Fort McMurray, as this opportunity could be prosperous for the company? Second, should we be building new stores within Fort McMurray? And last but not least, given the 3 different stores that are, or 3 distribution centers in Fort McMurray, should we acquire them or should we, moving forward, stick to the other 2 alternatives? So when looking at these, we based every decision or every recommendation for you based on 3 different criteria. So first being the economy. What is the economy looking like in Fort McMurray? Are the oil prices going to increase in the foreseeable future, or are they going to remain low, or are they even going to get lower? Secondly, scale of operations. We understand that currently you are operating in Eastern Canada, in Ontario and Quebec in a very prosperous manner. So we want to make sure that moving forward with the scale of operations, you're not increasing the risks of having to operate in Western Canada and also Eastern Canada and spreading the company too thin. Secondly, the supply partnerships. We want to make sure that whatever recommendation moving forward, that you are still maintaining partnerships, you're still maintaining that positive relationship with Komatsu.
So looking at our first alternative here, exiting Fort McMurray. Obviously, with the fluctuating oil prices, it is a pretty scary situation, and this is a viable alternative. But looking at the economy, it is very safe to leave, and you could sell for a profit. However, that being said, because oil prices are so fluctuate to such a high degree, they could be very high again within a short amount of time, and you could have given that market share that you've worked so hard to gain away to your competitors, and it may be nearly impossible to gain it back. So looking at the scale, you've already consolidated from 5 distribution centers down to 2, and you don't have that management in Alberta at this time. So while this would make it easier to exit Fort McMurray, if you did choose to stay here, those would be issues that you would have to address, as there is some a bit of disconnect with the managerial level. And then looking at the supply partnerships, if you were to exit Fort McMurray, you could focus on those Ontario and Quebec relations, but as I mentioned earlier, you would be ceding that market to competitors, and it would be very, very difficult to gain back.
So the oil industry is a very cyclical industry. Over the past few years, when oil prices are doing really well, your company is actually doing well in the Fort McMurray areas. But since the oil hits lows, and you start to worry about your operation in Fort McMurray, so we actually run the NPV analysis on the only 2 stores in Fort McMurray, and the NPV is a positive $0.23 million, and the assumptions, as you give it to me, the future 5-year projections, it's relatively bearish, relatively bullish, and we actually run the relatively more conservative assumptions. It gives you a negative $0.5 million, but please mind that because if you exit Fort McMurray, your key supplier, which is commercial, will actually go to your competitors. You potentially will lose some of the relationship with commercial, and you will affect your current operation in Eastern Canada, which didn't reflect here, and we think it's actually higher than the losses. Losses in Fort McMurray if the oil stay low for longer. So that's why we don't recommend you to exit the Fort McMurray opportunity and just keep the relationship going.
So now that we've decided that staying in Fort McMurray would be the best move and really maintaining that relationship with Komatsu, you've got 2 potential opportunities within Fort McMurray. The first being to build your own new stores, still partnering with Komatsu, and the second would be to acquire 3 potential stores that are currently operating in the market. So looking at the first one, building new stores. It is a rather immature market right now for rental equipment, so that is something that you could leverage and try and get that first mover advantage, so to speak, and really get your foot in the door and cement your market share. However, demand is expected to decrease to 30% due to those fluctuating oil prices. So it's a bit of a give and take in that you would be able to get in, but the demand might not necessarily be there for the next couple of years or so. Looking at the scale though, building new stores would be a positive, as you can definitely choose exactly where you want to be to leverage the population and the demand to the best extent that you can. However, because you will be building these own stores, hiring new employees, hiring new managers, training them, it will take a lot longer to launch than the other option. Lastly, looking at those supply partnerships, you do retain that relationship with Komatsu, so you'd be able to get that line of credit that they do supply to you, and that's something that we see as very positive.
So based on our NPV calculation, this is on the 10-year investment horizon, because we want to compare directly with the third option, which is you operating your own stores on behalf of the commercial equipment. So the net present value is so building the new stores, the net present value is actually a negative $101 million, and the reason being is that you're constantly investing in new stores. So so for the first 5 years, you are going to open new stores 1 or 2 per year, and the next 5 years will be based on our schedule will be keep the same expansion level, and in 2019 you will reach your target of 20 stores in Fort McMurray, and because there's a constant investment in the first 5 years of $35 million to $40 million, and for the next 5 years will be $10 million investment each year. We do recognize that capex is too high, and your profit generated for the additional new stores added doesn't compensate the capex you have. So you mentioned that the contribution margins of each additional stores will be 200 million, will be 200,000 per year. We do recognize that in our net present value calculation, and we use a 10% discount rate, which is a standard rate in the oil gas industry. And we do run the sensitivity analysis. We find the NPV range is still negative, even though the discount rate varies in 8% to 12%.
So now that we know we're not exiting Fort McMurray, we know that buying new stores is going to give us an extremely negative NPV. So that really leaves with one option, and that's the acquisition. So as you mentioned in the documents that were provided to us, you are concerned that it could potentially damage your financial stability. However, with our forecast, as Vivian will talk about later, you'll see that while it is a little bit iffy for the first couple of years, it does smooth out and it does become positive in the long term. So this is a good option for you. In terms of the scale, you would be able to immediately increase profits, as you'd be able to replace the merchandise in whichever store you chose immediately with Komatsu merchandise, which offers customers a greater degree of diversity of product, so they'll keep coming back because they like your store, and it's also going to immediately increase profits for you, Garamond, as well. And then looking at supply partnerships, it does maintain that critical partnership with Komatsu that we see as being very valuable, as they provide quite a stable base for your operations.
So, looking at the acquisition, so we identify there's 3 potential targets for you, and one is a Transurx, one is a Qualitative, and one is a Vanguard. So we look at their key ratios stated in the cases you, as you discussed with us. So the debt to equity ratio will find that Vanguard is actually has a higher debt compared to their equity. Profit margins, 3 firms are pretty much in line, and Vanguard is slightly lower than than its peers. However, we find they are all the 3 firms are at a solid financial position. Vanguard is a little bit weaker than its peers, but we still think it's solvent in terms of its financial position. And also we also do the qualitative analysis on the 3 firms. So Vanguard, we want to choose Vanguard because Vanguard has the relationship with the other 2 key suppliers in the market, which can help you to diversify your high reliance on commercial currently, and because Caterpillar and other firms already have the relationship and already have the expertise in the technology advantage in the Fort McMurray and the oil gas industry. So we believe we should go for Vanguard. And based on our calculation of a PE ratio of 7 times, the reason we use a very high PE is because we do recognize there's a huge spread between the bid and ask prices in the current market. As you already mentioned, those rental firms, they are well capitalized. Their family runs. They can actually potentially survive in this oil this oil downturn, and they are not hurried to sell their firms. That's why you probably will see this spread exist for next year or 2, and because commercial actually give you lots of pressure to enter to expand relatively quickly, so you probably will get relatively higher prices. That's why, to be on the conservative basis, we use a 7 times PE ratio, but we do recognize that potentially you can negotiate lower prices than the PE of 7 times. And so this is the NPV we calculated. So we have a bear case, base case, and a bull case. So so the bear case, we model for a longer period of oil recovery. So in 2015, there's a 30% drop. We model that, and in 2016, there's another 5% drop in your revenue. And going forward, we model for relatively bearish 2020 year recovery. So from 2017 to 2020, there's only 5% increasing in revenue. So it's a very, very slow-paced recovery. And in 2020, it starts recovery to 2015 levels, which gives you an NPV of $1 million. Our base cases is based on relatively quicker recovery, which is actually based on industry average. So over the past few years, the industry growth rate has been 15% annually. So we use 10% for the 2017 to 2020, and going forward, we think you can keep this level. So that's our base case. And the bull case is that because you can actually find other suppliers, potentially it can improve your profit margin. So we model for that, and we for the recovery case will be the same as base cases. So which give you a 4 million net present value. So look at those different scenarios. They are all positive, and we believe that from the financial perspective, it actually offers you the great opportunity to get into this business. We know that this is an oil downturn. Nobody really wants to invest because everybody is uncertain about oil prices. But you have been survived in the past oil downturns already. As you indicated in the 1980s, that's a low oil environment as well. But you capitalize the opportunity to expand your business. You have proven the ability to actually do really well. So we think the oil will recovery, and we already consider the 3 cases. It all gives you a positive NPV. And how are you going to financing it? So since you due to your close relationship with Commercial and your previous agreement with them, so you are going to acquire the loans from the Commercial, and will be a very, very reasonable rate at a prime rate of 2.27%. So we calculate the interest payment and principal payment. So we model this for annual payments of equally amount over the 10-year horizon. So it will be roughly $10 million every year, and the interest payments will go lower. And look at the profit you have is actually, you can actually cover the interest payment and principal payment and give you some profits for your own company.
So just diving a little bit deeper into what Vivian mentioned earlier, we know that there are 3 different options of which company to acquire. So looking at the options, first we looked at transfers. Well, only 40% of their sales actually have to do with equipment, which is what Garamond operates within. So we didn't feel that that was a high enough product offering to be able to justify acquiring their business and needing to pull in people to provide expertise for different product lines. Additionally, they complete acquisitions themselves. So there's always that risk of them wanting to be in the driver's seat when Garamond is the one doing the acquisition. So there could be a possibility for some friction there. Second, looking at Kaildon, there is a very broad selection of the opportunities that they have. However, they are very widely spread out, which could be difficult to manage. And they're known in the community, Vanguard is known in the community, and they have a high level of expertise.
So what is our recommendation for you moving forward today? Our recommendation is to actually stay in Fort McMurray and actually acquire one of the companies, and we call this creating connections. What have you heard today? So today, we want to make sure that currently within the current stores that you're operating in, they're very prosperous. You guys are generating a positive return on your investment. So moving forward, we want to make sure that Alberta prospers. Fort McMurray needs to have management in their day-to-day operations to ensure that in its operations, everything is working smoothly. So we want to make sure that we're renegotiating the contracts with Vanguard and leveraging their expertise moving forward. Thank you.
Thank you. This concludes our presentation piece. We'll now go on to the question and answer period.
So I guess I'm just wondering, if I go ahead with this acquisition, how is this going to affect my balance sheet? How does the accounting work for this?
So how it affects your balance sheet is that when you're taking on Vanguard, you're actually going to recognize their debt, their liabilities into your financial statements as well, and you're going to operate with kind of their day-to-day operations of consolidating and acquiring the company. So you have to assume all the debt and liabilities that we have as well, and then their assets that they're leasing out to their customers will acquire their assets as well, and that will also be included in your long-term assets involved in the balance sheet.
Sorry, just to follow up on that. So since you pay the premium for the firms, and you actually will have a goodwill on your balance sheet because because you have the acquisition premium, and potentially you fair market value of the equipment. You just use the fair market value of the equipment. Potentially you can have some bargain there, but we believe that using the 7% PE, you do generate the goodwill on your balance sheet. And because you're going to take the loans of around, as we indicated, $85.7 million, so it actually will lever your balance sheet. But we believe over the next 10 years, you're going to pay down the debt. So initially, you will increase your debt to equity, but going forward, you actually bring back to the more healthy levels. And because you keep relationship in commercial, so you actually have some funds guarantees from the, so you don't really need to worry about the liquidity issues.
Did I hear that as part of acquiring Vanguard, we're also going to maintain the other brands, the Caterpillar and other, in terms of a diversification strategy, or would we be phasing those out for Komatsu?
Yeah, sorry, just to clarify that. So what we did mention was that immediately when Vanguard is acquired, you would be able to begin transitioning that stock immediately, as you do want to really maintain and firm that that relationship with Komatsu. And if you were to sell Caterpillar products, like you mentioned, that might create a little bit of friction there. So we would definitely be transitioning towards Komatsu.
For me, and you just kind of got into it at the end there, the big part for Garamond, what's really important to us is our customer and those customer relations. And so now all of a sudden we're going from 2 stores to a whole bunch more stores. So how are we going to manage that to make sure that our vision and our values are actually going to be implanted in all these new stores?
Absolutely, and I'm really glad you asked that. So the one thing that we do want to implement for sure is bringing in some senior management to Alberta, as currently most of your senior management is based down east, and we think that by bringing some senior management, bringing some expertise into Alberta, you're going to be able to give a closer eye on those stores and make sure that you are delivering Garamond's values. Additionally, with the acquisition of Vanguard, you're going to be able to leverage their experience within the community. They've been operating within Fort McMurray for 15 years, and we think by marrying that new senior management as well as the experience that Vanguard offers, Garamond can provide that high level of service to its customers, ensure that they have the highest quality offering of products possible, and continue to operate in that capacity in the future.
You mentioned that, so I'm drawing on another point, that the target company has 2 other brands. Are you suggesting that you eliminate both other brands and go to 100% Komatsu product line?
Yeah, for sure. So my apologies if I wasn't clear on that before. It would be sort of a slow phasing out process. So eventually we would be looking just to do Komatsu, as there's been such a long past relationship with them in Garamond. However, it wouldn't just be immediately as kind of a shock to customers that all of a sudden these products that they're used to are pulled off the shelves. It would be a much more gradual process in that they would be able to recognize that Garamond and by extension Komatsu offers very similar products to what they're used to and can transition to those.
Great, that concludes the question and answer period.